Gerald Holtham is managing partner at Cadwyn Capital. They're preparing to launch a new hedge fund. He joins us in the studio now. Gerald, thanks so much for coming in. So if we look at what we've seen this morning, pretty remarkable rebound after the week that we've had, rebounding from two-year lows. Question is, will the rally last?
I don't think this rally will last. After all, we had a bounce 2 days ago, which looked quite good at the time, before another dump. I think we're in a very choppy period. I've got no theory that says we're necessarily at the bottom. But I do agree, if you can look 5 years ahead, I'm sure that those investment bankers are right. The market will be higher. So I think if you're not a trader, if you're not a professional manager who has to worry about the next quarter, this is a buying opportunity, but you're going to need very steady nerves.
Okay, so further volatility to come from what you're saying. How low could we go?
You know, when you look at bubbles in the market, they will always exceed your wildest imaginings. I mean, we could go another 10, 15%. I don't think we will, but we could.
Yeah, and you're saying that there is a substantial risk of a stalling global economy in the third quarter. I mean, we've been speaking a great deal about that, so that could deal another blow to equity markets. So even if we see a rally now, you know, data coming up could actually be, you know, counterproductive.
Yeah, I mean, I think the conventional view, and for once I have to agree with the conventional view, is that we're probably in a Japanese-type situation with a very slow growth hampered by deleveraging and low confidence. That said, when you're growing that slowly, it doesn't take much of an event, you know, the European situation, for example, to push you into a quarter or two where it's actually negative. Again, I've got no theory that that's bound to happen, it just might. And while the markets are worried about that, they won't find a secure bottom.
Yeah, and so then I'm wondering, is that something that we have to learn to live with, this increasing market volatility? Is this actually going to be a trend that we see in years to come? Because the issues that have prompted it, European debt crisis, US debt, they're not going away anytime soon.
No, I think that's right. I mean, if you take a longer view, you know, I mean, equity markets tend to produce 6-7% returns a year over the last century and a half. But between 1980 and 2000, they were doing 15-17% a year. No, unsustainable. Since 2000, we've done nothing. We haven't gone anywhere. So you average it all out, and you know you're back to the 6% a year over a very long period. So I think the markets have now purged their overvaluation. I don't think we're overvalued anymore.
So we're where we should be?
We're roughly where we should be, and I think therefore, with slow growth in the economy, we can get returns in equities. But it's going to be choppy while the market works out that there's not going to be another recession.
And amidst all this volatility, how do you determine where to put your money in this kind of environment where the best returns will come from?
Income. If somebody's paying you a dividend of 8% and it's well covered, that's pretty good. So you look for stocks which have got a solid balance sheet, our cash cows are paying a high dividend. They won't be, generally speaking, be go-go growth stocks, but in this choppy environment, you're going to be all right because you're going to pick up that 8-9%, and that's going to look fairly clever if the market falls.
Yeah, and I mean, I'm just wondering about this, you know, you speak about market falls, and we saw this remarkable sell-off in European bank shares at the end of trade yesterday with a 15% slump for SocGen. And the interesting thing about it was that, you know, there didn't seem to be anything fundamental at the heart of it. It was just total irrational fear. And actually, I was speaking to someone earlier on the show who said, listen, their balance sheet extremely robust. They're in a better position now than they were in 2008. So even if a company is doing well, it doesn't need to be reflected in the market.
Just think what you just said. They're in a better position than they were in 2008. In 2008, what sort of doo-doo were they in? So, yeah, I mean, I think the trouble is people have no confidence in the transparency of what they're seeing. The various bank stress tests that have been carried on banks have not been rigorous enough. And I think this is the big problem in Europe. If the governments had got together, insisted on strict stress tests on their banks, including the options of defaults by the southern European countries, and then worked out how much they had to subsidize the banks and how big a hit those bank bondholders would take, if they cleared the stables, this wouldn't be happening.
So given the lack of transparency that you described, can we expect money to continue flowing into safe haven assets, gold, Swiss franc, Japanese yen?
Yeah.
Yeah. Do they look? I mean, are they attractive to you? Is that the sort of thing you're looking at right now?
No, I'm too wary of things that get too rich, even if it looks clever over the next week, month or whatever. Maybe because I've got grey hairs and I've lost my nerve. But basically, when a thing gets very rich, I like to leave it to the next guy. I mean, there's no sense in which the Swiss franc is at an appropriate level from a purchasing power parity point of view or a foreign external balance point of view. So maybe it'll go up, yeah. And I'm very happy to see some other guy make the money out of that. But once it gets that rich, I'll go and find something safer.
And does the increasing intervention of central banks in the markets, we saw it in Switzerland, also with Japan, does that make you nervous?
No, I think what's that doing is pumping liquidity into the world economy. I mean, the Japanese are having to print money in order to buy those foreign assets to keep the yen down. And so it's a round the houses backdoor way that the governments, almost without realizing they're doing it, are pushing money into the world economy to try and give it a lift.
Yeah, thank you very much. Good to get your thoughts. Gerald Holtham of Cadwyn Capital, managing partner.